Crunch time for US data this week, but are the stats still sound? The Bureau of Labour Statistics abruptly postponed a key consumer spending report late on Friday, offering no explanations. It's the latest in a string of concerns since President Trump fired the agency's chief. With BLS staff down 20%, inflation metrics increasingly based on estimates, and a did he have a week ahead? Can we still trust the numbers? Russ Mould is investment director at AJ Bell. So Russ, is this a worry for investors and the Fed? Will they start to look beyond government agencies for reliable data?
Yeah, it's not ideal. I mean, it's no consolation to the Fed that it's not unique to them. I mean, the Bank of England is wrestling with unemployment data here in the UK that it feels isn't perhaps as reliable or comprehensive as it once was. The Office for National Statistics here has been struggling to get data in from respondent firms, and it feels as if the Fed's had the same problem. The Bureau for Labour Statistics has had the same problem with the same knock-on effects. I guess the worry for investors is if you have unreliable data going into the policy-making process, do you have policies that come out of the other end that aren't necessarily fit for purpose either?
Well, a lot of Fed speak is due this week. Will markets pay more or less attention to Moran comments given his connection to Trump?
I think given the nature of his appointment, I think Mr. Moran seems to be having a disproportionate impact upon investor sentiment, and certainly paying very, very close attention to what he said. He was a dissenter at last week's FOMC meeting, and I think he'll probably continue to push for very rapid interest rate cuts, regardless of what Chair Powell seems to say publicly or think privately.
Well, the Fed's preferred measure of inflation will be released this Friday, but has the focus and importance switched away from prices?
Chair Powell's comments at the FOMC meeting last week did suggest that although inflation remains a clear concern, because it's above target and it's proving sticky, it does feel as if the Fed is now more concerned about rising unemployment. That said, at 4.3% on the official U3 rate, it's not historically high. But if you look at the U6 rate, which includes those who are looking for work, can't find it, or having to work part-time, then that's at 8.1%, and that's kind of a 7-year high. So that may be some greater cause for concern. The other challenge the Fed has got is that even whether the data is reliable or not, unemployment data is a lagging indicator because of how long it can take you to go through the process of unfortunately letting somebody go, or the more exciting process of finding the right candidate and hiring them. So you're working with data that's probably got a natural built-in lag of 6 to 9 months anyway, and you're trying to set policy data for 12 to 24 months time. So it's not an easy balancing act. And as Chair Powell himself said, there is no straightforward, obvious action to take.
More recent labour market data, though, showed initial jobless claims dropping by the most in nearly 4 years last week. Are concerns about the labour market overblown?
Yeah, and the other interesting stat to watch is the continuous unemployment claims, which had risen quite sharply this year. That's also come off from its high of July, just below 2 million. So a reduction in that would really offer some comfort, I think, with regard to the jobs market. But overall, if you look at the Atlanta Fed GDP Now data, they're forecasting 3.3% annualized growth for the third quarter of this year. If that's correct, and it's well above inflation, then that would be a reassuring figure all around. And if anything, the Fed might be then wary of cutting because the economy would be still running, pretty hot, if the truth be told.
Meanwhile, Tuesday brings the flash release of September PMIs. Last minute's numbers reflected growing optimism about the US economy. Can we expect more of the same?
It might be worth digging past that, the headline PMI reading, because particularly on the manufacturing side, order books have been soft, employment and hiring intentions have therefore been soft as a result. But again, some of these numbers are likely to be quite noisy for some time, just because of Liberation Day on the 2nd of April, subsequent delays in the imposition of tariffs, then new deadlines in August. Companies have had an awful lot to deal with. You couldn't blame them if they'd stocked up on inventories where they could to prepare for it, to prepare and put a pause on hiring. So we'll probably only get a real feel for what's going on in the US economy, maybe 3-6 months' time, of course, assuming the tariffs are left unchanged. And I'm sure there's still scope for further negotiations along the line.
So overall noisy data all around, but is the aggressive easing by the Fed that's priced in by markets justified?
I mean, if the Atlanta Fed is right with 3.3% annualized growth and with inflation above target and the stock market roaring along, you do have to raise questions as to whether they're running the risk of letting things run too hot. Equally, that's what the president wants. He's talking the dollar down, he's talking taxes down, interest rates down, he's talking deregulation, he's trying to talk energy prices down. He is looking to run the economy hot. And if you can get nominal growth to clip along, keep interest rates below that, your debt to GDP ratio mathematically declines, and that's something that's exercising Treasury Scott Bessent. So you can see why they're going down that path. I think the Fed, once it's committed, will probably stay, and it is under political pressure. But I think looking at the gold price and looking at, say, 10 and 30-year treasuries, other markets are worried that, yeah, they may be running it a bit fast and a bit loose.
That was Russ Mould from AJ Bell. Don't forget, you can watch more videos on Reuters.com.